let's talk about another way of controlling or influencing aggregate demand other than fiscal policy. Why do we need to look at that? Well, as I stated before, a lot of governments of Western economies have chosen to be less controlling with respect to fiscal policy, and they handballed, if you like, or given the responsibility of managing or influencing economic activity to the central bank. So that the central bank would be responsible for implementing what we call monetary policy. Now, effectively, what we're going to see here is we're going to be looking at how changes in interest rates can actually influence aggregate spending, therefore total production, therefore jobs, therefore prices. Remember, I also said that central banks, e.g. of countries like Australia, have got a specific target for, say, a desirable macroeconomic objective, which in our case is price stability, that they're happy if over the course of the business cycle inflation averages between 2 and 3%. So let's have a look at what they might do, for example. What might they do if they felt that there was inflation on the horizon attached to high levels of spending? In other words, what you and I would call demand pull inflation. What might they do? Well, they would look at the key drivers of economic activity, and they say, okay, what we want to do is actually just slow down or dampen the level of spending a little bit to take the heat out of inflationary pressures. So they might act to increase interest rates. Now, the interest rate we're talking about here is what we call the base rate. You can read about that if you get really, really interested. And how they do it is another interesting thing, but beyond the scope of this little course. But let's assume that they can do this, they can increase the base rate, and it will actually increase effectively the interest rates on all other financial products and services, and in particular the cost of borrowing. So the cost of borrowing, for example, to buy a new house will go up. The cost for a business person to establish a lease or to acquire new capital equipment would go up. So it becomes a deterrent, if you like, to potential borrowers if interest rates go up, because the cost of servicing the debt is going to rise. So if interest rates go up, what we would be anticipating, hopefully, is that there would be a decline in C. And don't forget, this would actually apply also to existing clients who are servicing a home loan on a standard variable rate. If rates now go up, the bank passes that rate on to the customer. Therefore, they need more money per month to service that debt. Therefore, they've got less money to spend on consumer goods and services. And in addition to that, we'd also see that there is that likely decline in investment expenditure, because ceteris paribus, we established that there's a fairly strong connection between rising rates and falling levels of interest, because again it becomes more difficult for the business to service the debt because the bank wants more money back per month. So put these two together, and of course what we're going to end up with is a decline in spending, and of course that's exactly what we wanted to achieve, to diminish the possibility of demand pull inflation, so that we keep our, if you like, that cost of living or CPI in that band of 2 to 3% in the case of the RBA in Australia. Now this would be obviously contractionary. So we're diminishing or contracting or getting spending to fall that little bit. Of course, the opposite would be also true. For example, if the RBA felt that there was rising cyclical unemployment, which of course we now know would be attached to a downturn or a slump in economic activity, they would do the reverse. They would do the reverse. In other words, hoping to stimulate and expand economic activity to avoid this outcome, the RBA might act to bring down the base rate. So the cost of borrowing falls. Therefore, the hopeful outcome is that interest-sensitive consumer purchases, new houses, new cars, new swimming pools, etc., for which we generally have to borrow, that we would expand those levels of expenditure. And of course, we would hope also that businesses might find the level of debt servicing more comfortable. They increase their level of capital goods acquisitions. And again, what have we seen? We've seen now an increase in total spending. And of course, we know that increased spending, increased output, you need more people working, ergo, you're going to decrease cyclical unemployment. Now, this is fairly broad, and there's lots of other little nuances and intriguing things we can look at. But for the sake of this little course, keep your mind on the macroeconomic goals, and those goals that can be influenced by what we call total spending, sometimes aggregate demand or aggregate expenditure, and those individual components which we might be able to influence by, in this case, judicious adjustments of the cost of borrowing money. Now, I can't leave you with this rather simplistic overview without mentioning something which you'll probably see in the paper, and that of course is the role of expectations. Now, the RBA is very transparent with respect to their goal for price stability. So pretty much everyone knows, all major players in finance markets know that if, for example, if the CPI is creeping up towards the top end of that band, that the RBA would be getting uncomfortable, and they would anticipate a price rise in the cost of borrowing. So when the RBA meet, as they do, first Tuesday of every month, in a lot of cases, financial players have factored in what they anticipate the RBA is going to do. So I don't want to leave you with the idea that the RBA put rates up and down in a random manner, and I certainly don't want to leave with the idea that there's a randomness here, because people have become far more intuitive about reading what they're going to do. Having said that, it is possible, of course, markets can get it wrong. Even the RBA or the central banks themselves can get it wrong. For example, as you know, if they misread where we are with respect to that natural rate of unemployment, for example, a decrease in interest rates would actually surge our total spending beyond the level of the economy's productive capacity, and that might create the very thing that they want to avoid, namely demand pull inflation. So be aware that even more so than fiscal policy, monetary policy is very much an art and not a science.